Newfound Gold has discovered 93 grams per ton of gold over 19 meters, starting at only 96 meters downhole. Some of the biggest names in the mining world have shown their approval of what Newfound Gold has discovered. They now own over 35% of our shares. With over $70 million in working capital, Newfound Gold is well positioned for what the future brings. To learn more, find us online at newfoundgold.ca.
Welcome back to Palisade Radio. This is your host, Tom Bodrovics. Joining me on the call again is Patrick Karim from badcharts.com. He's a proprietary capital manager and chart trader. He's also the brain behind Bad Charts 1 on Twitter. He posts a lot there, and we're always happy to look at his charts. How are you today, Patrick?
Well, I'm great, Tom. Thanks for giving me a call. We appreciate it.
Always great to talk with you. So let's just jump right in here. The first chart that we're going to look at is a silver chart, and we have a $70 price target by about this time next year. So walk us through this chart and tell us what we're seeing here.
What? I did a $70 target? Well, look, I was having fun with fractals. Fractals is like, they're super dangerous because then you start, like fractals is like the green zone. So you highlight a exact pattern. It's like a copy paste. And then you take that portion and you try to fit it where we are, like how we're already running through that previously accomplished pattern. And I did the 1970s to 1980s bull market for silver. And I said, look, what if we're already doing that? Like we already had a strong parabolic move from those lows there previously, just before March, that we started going up. And that angle of ascent looked pretty much like what we're doing in the 1970s. So always trying to find clues. Like this type of chart actually is more like a greed chart. Say, okay, how high can silver go? How high did it previously go? For sure, like everything's different these days. You know, the macro drivers, maybe they're different. Some guys like that, we're heading into inflation versus deflation, all that. But just to see how silver previously reacted in a bull era and trying to fit that on the chart and see if it fits properly with the price action that's already previously done. So on the right side, that's the paste. That green overlay is the paste from the 1970s and 1980s bull run. And right now, we are here like at $26, and it followed pretty much the same angle.
So Patrick, just to interrupt you for 1 second, is the reason that you're using the 70s bull era chart because of that angle?
Yes. The more we've been moving up strong, the more that angle started to look like the 1970s and maybe a little bit less from the 2010. It looks a little bit like it, but when you take that section, actually you have the extension like that goes all the way to 70, and then that pullback that I'll see. So I put that 50% correction in March. That's 50% correction, not of the price of silver, but the actual move. So from $14, we went all the way up to, let's say, $69.70, and then we correct 50% of that. And that coincides perfectly with the $40 top from the 1980. With a little noise from the 2011 top, we're pretty much at that wall, at that previous resistance turn support. So it matches pretty nice. So this is a type of scenario. And then I don't have the overlay here. You could look at maybe somebody at like North Star's cycle charts. That high going down and that low, so that 50% correction in March, that would bring us back down to $40 to test that. That brings us to his 8-year cycle low in 2023. So another evidence that if we'd repeat that pattern, that angle of ascent, that pullback rapidly, the time that it took from the low from $14 all the way to 70, it plays out pretty much. So if we'd have we wanted confirmation bias that silver can reach 70 in the next 12 months, then this is like a roadmap that would get our greed really going. Oh, look, guys, I could buy calls now, silver calls. Pat said it's going to 70 by August 21. I'm going to be a millionaire, you know. But that's why we have other charts, right, to check the weight of evidence. And then after that, we have to find charts to try to not eliminate that possibility, but counteract, Are the indicators overheating? Do I have fuel in macro driver reservoirs for silver? And I think the other charts we're going to look at are going to show us where we're at in the reservoir. And do we have enough drive to be able to get to that $40 silver and eventually go parabolic to 70? And that would be a burnout phase. If somebody would want, if we get the $70 in August 21, that could be like, especially with that angle of ascent, that could probably be a place there to take some profits there off the table. So this is purely greedy targets. This chart was super popular because it gets that emotion from people, like, wow, I just joined the bull market and I'm going to be super rich. Well, this is a chart that you want to show to your dad there before you ask for money.
And Patrick, before the call, we were talking a lot about these angles and it's coming up again. So let's talk a little bit about the angle of entry and the angle of exit when it comes to price action.
Exactly. So with ARCs, if you take the 2011, 2013 drop into the bottom that we've had there for 6-7 years, from 2012 to 2014 to 2018, 19, we started going out. So usually since we drop super fast in, there's not that much volume, not much transaction of people buying and selling, right? Drop so fast. So on the way up, the theory is that when you go up, there's not many people that bought on the way down that fast, right? And it creates kind of a vacuum that we've seen previously on my volume defined vacuums. And the angle should be the same angle of exit. So if you want to do like time targets, you want to see how fast you're going to go out. Well, look how fast you went in, and the exit should look pretty much similar to that. And we had a pretty fast drop in 2013, pretty aggressive. So it's not out of the possibility that we exit at the same speed. And as we've seen, like after our first interview, when maybe a week later, their silver exploded up, it went up fast. It really respected that concept of the angle of exit out of the base, which would fit in a symmetrical arc. It was practically a mirror image of what happened on the way down in 2013. So that's a lot of things like symmetry, reverse symmetry, like a lot of people call. It's another facet of technical analysis that you could use to your advantage. And if we could sound this chart just a little bit more, just like zoom out your eyes and just look at the drop from the 1980s all the way to that base, let's say 1989. And then there was a base. And look at that, when we exploded from 2001 to 2011, it's practically a mirror image. As much as you could in a chart there, it's always going to be slightly different. But if you flip that in half, fold that paper in half, you'd see that somebody with the technical analysis and knowledge of the arcs and reverse symmetry and exit angles, you could have almost guessed that you were going to reach that $40 target at pretty much that timeline.
As it said, it's not going to repeat, but it definitely rhymes, right?
For real. Yeah. So we're not going to get the same green thing like I did a copy paste. It's practically guaranteed that it won't be the same, but it starts getting your possibilities that what could happen there.
Perfect. So let's move on to our next chart here. Gold is the roadmap. Can it be that easy? So what's your price target for gold here going into the same timeline for about the next year?
Yeah. So right now I wanted to right away started to get my greed in check. I said, okay, I want some evidence. So usually gold is like the precursor for silver move. Silver catches up to gold. The gold silver ratio goes down. So if gold can show me that it can go above its all-time highs and it has a strong angle of exit as it went down, for me, it's kind of like a crystal ball. The closest I'll get to a crystal ball for silver, maybe like a year, 6 months lag, that silver will do the projected move all the way to 69, like that burst above all-time highs. And gold is actually doing it right now. It burst above its all-time monthly defined highs, above 1800, and it's actually going up at a strong angle of ascent. So that 2300 target, I have it on some other charts. I think it's going to happen probably before silver reaches its target in August of 2021, that 70 target. So maybe a few months before it's going to hit it, and silver is going to keep going parabolic, outperforming gold, lowering the GSR. Well, it could actually happen very soon. So maybe this quarter or next, or maybe early next year, we should have 2300 gold. And that's what fascinates me, like with big numbers. Often gold going to 3,000. It can't go to 3,000. That's like it's a big number, but 2,300, that's only like 10% from where we are now, 10, 15%. It's not that much, So it's very reasonable that gold can gain 15% in the next quarter or next 2 quarters to reach that target. And then if we'd have that 50% retracement from that move from the bottom in 2018 all the way to the high, then we have a 50% correction back to 1,800. So the previous all-time highs, which used to be resistance, now support. So that'd be the roadmap for gold, having its low also in 2023, its cyclical low back to 1,800, 1,900. And people sometimes, Tom, they're always like scared, cyclical low, and then they think it's going to crash like a low, all-time low. That's not what it means. It means you'll have a low, an important low, but it's going to be a higher low. So if we're like in a mid-cycle from let's say a 16-year bull market cycle and we're halfway through, it just means that we're going to have a low. So off that 2,300, we're going to go down to like a 50% retracement of that move to 1,800. And that would be your low. That would be your next great entry, your next great reload period where everybody's giving up on gold, saying gold sucks and all that. That's when you'd expect there to enter there on that pullback.
So, Patrick, you and I spoke last somewhere around a month ago, and since then, we've seen the new all-time high get broken by gold. What are some of the tools that you're using to be able to look at the price of gold? If we look at this chart right here, is theoretically no man's land because we're above that new all-time high. This is all new territory, right?
Exactly. So the only rule map we have now for gold, which was my original rule map, which got me a gold bug, was when I looked at gold in other fiat currencies, right? So fiat currencies are debasing each other at different speeds. The US one is resisting the most, but if you look at gold expressed in euros, gold expressed in Canadian dollars, you kind of see the rule map of how they handled their all-time highs. Because gold in Australian dollars, it's all-time highs, like way high, you know? And what's kind of happening with those currencies is the big bowl we have here, the cup, is like a halfway flag. So they're starting to repeat 2001 to 2011 highs, or wherever they peak. I think it's close to 2011. And whatever consolidation they had for 6-7 years, they broke out above that way before US dollar did. And they're just continuing hammering on higher and higher. And it's pretty much repeating what's happening on the 2001 to 2011 run. So that's kind of a target of how you could expect gold to react, where it could stop. Some people are looking at Fibonacci retracements like I just outlined there. Usually you have a 50% retracement, or they use extensions. Then they see, okay, I extended that much away from Fibonacci. I haven't dabbled too much in them, but I guess now since we're in the all-time high territories, it's type of tools that you have to refer to. So either look with gold versus other fiat currencies, how they're behaving, or start using some Fibonacci extensions there or measured moves to see where you're stopping. So yeah, just like the base, 1800 minus the base of gold, which was like 10,000. So 1800 minus 1,700 added to the breakout line, 1800 plus 700 measured move. It brings me all the way, like, let's say close to 2,500. So those are targets the classical charting patterns are angling towards. See, everything's getting close, 2,300, 25, 2,600, a lot of targets, people, different methods. But that's pretty much where you should start looking to take profits, or where you could, before an important correction.
Perfect. So let's move on to our next chart here. And this just highlights more evidence for this trade. So why don't, before we talk specifically about the chart, let's talk a little bit about the correlation of the metals to real rates.
This is like practically insane. It's copy. You could overlay the inverse of the real rates with gold. And recently, and even previously, they've tracked pretty well. Then after that, you could deduce like all the theories. People say, well, if treasury bonds with inflation adjusted, they don't give you returns, might as well put your money in gold, right? So that's probably the cliche, or it's probably actually true that gold will be favored as an investment when the treasury bonds, inflation adjusted, they don't give you any returns or you go negative. So that's pretty much the theory behind it. Right on this chart, I did PNF. So to reduce noise, to condense, remove time, and just see pure price action, I did a box around my gold chart, which is on top, and my real rates, which are going down. And a box or the rectangle is just that, you know, you have two parallel lines. So it's a perfect channel going down. If you look at the real rates, so the chart on the bottom, every time the real rates hit that top rail, it's as high as real rates could go. And that's when actually gold bottomed. So those were great, especially the one in 2018 when it started going down. That was actually gold, like almost reverse copy, say, oh, real rates, that's it. They don't want to go higher. I have to start pricing in lower and lower rates. And that's when the driving the price of gold. And you see it's going down. And right now, we're actually broken down below the minus 24. So real long-term rates, if I could just add, it's like I put the description there. It's the maturities, 10 years and more. So longer-term maturities really give a clear signal for how gold reacts to those real rates. And we broke down. And right now in this recent correction we've had in gold, it's actually, we could barely see it, but it's actually the real rates going higher, going back high. So gold does not like that. Hey, real rates, you're retracing higher. So it started pricing a little bit of retrace there. But the goal of this is to see how much fuel do I have, those real rates, how much fuel before I say, okay, real rates, they're not going down. Inflation's never going to get up. Powell's going to start raising rates again. I'm expecting to hit that bottom trend line. And it's been tested 1, 2, 3, 4 times. And this would be the 5th time we test the bottom of that box. And that's fuel. We're just starting. So at minus 0.24, and that bottom rail, it's would be at minus 1.5, minus 1.7 real rates negative. And that's going to drive gold mirror image going up to its box. So I drew for the gold box on top, bottom rail, then parallel channel up. And that brings me about to 2250, 2350. So another target bringing me in the range of measured moves, bring me in the range of Fibonacci. And I have fuel. So I have actual evidence that I have fuel for it to go down some more. So people saying, oh, I'm getting in late. Well, you're not getting in early, because early was those guys that got in on the Powell pivot, but you're getting in at a breakout. And right now we're testing a pullback, and that thing should go down. And if I could add something, then I wondered, like, I didn't have the data for the 1970s, but one of my followers on Twitter, and in the 1970s, we hit minus 5% real rates. I was baffled, and it actually did it twice. So it hit the first peak in 1970s bull run, the rates went minus 5, and then it bounced back up, and then it went double dip to minus 5% real rates. And that's when gold, silver went ballistic to their blowout tops. So until we reach that bottom rail, bought right, sit tight. The rest for me is pretty much noise. And that's how I use that type of chart, Tom.
Perfect. So Patrick, where are you getting the information, or like say that chart for real rates? Like how are they measuring that? Do you know?
That's from the U.S. Treasury. So there's a website called QuantDL, and they have a whole different feed sources from a whole bunch of places, from the Fed, from central banks around the world, from Canada, governments, a whole bunch of stuff. They all go on, they feed to QuantDL, and they give, and after that in TradingView, I just plug in that ticker right there. So anybody could see what I'm seeing here by doing QuantDL, 2 points U.S. Treasury / real long term. And if you go on their website, they actually explain how they derived it. So that's like the other box I put just on top. So it explains how it's calculated. And they actually tell you that, yeah, the data comes from the U.S. Treasury. So that is updated every night. And I've noticed sometimes that when there was a pullback on the close, the next day, it kind of gave me a feel of how gold would digest those daily closes of real rates.
Perfect. So on our next chart, we have silver overlaid with the exact same data to, again, just kind of weight the evidence in favor of being in such a heavy bull market for silver, right?
Yeah. It's like silver there, people, I have to take profits. It went up so much. And it reminds me like of when I played the 2009 stock market, like going out of the market crash at GFC. And I was doing Stan Weinstein back then. And then the stocks started going up above 30-week moving average. And then I had stocks that 2 baggers, 3 baggers, and I sold. It went parabolic. But after that, after a few years, I looked and they did 10 baggers, 12 baggers. And I was like, Pat. So again, that Jesse Livermore, like buy right, sit tight. I'm using that experience from that 2009, always trying to sell too early, always trying to capture profits. There's cliches to reinforce that, right? It's never wrong to take profits and all that stuff. But you have to really adapt your trading framework. You got to decide ahead of time what you're going to do. You don't want to get trapped. And when you see this ascent, like the top chart there, you want to see silver going super strong. Yes, it's going to correct severely, but are you willing to get 100% out and then try to time it back up? It's like all type of questions that a lot of people are asking themselves, and they should have those answers before entering the trade. How are you going to handle it? Because silver has shown us in the past that it's going to go crazy. It's going to go crazy. It's going to drive you crazy. And you need to reinforce. It's like, guys, you build conviction with belief, and you build belief with evidence. And then you're able to hold on or know when the ride is not over. So this chart for silver, it shows me that it's respecting, it actually has to catch up to gold to get to that $33 line for silver. For me, is just catch up. So it's to bring back to equivalent to where gold is now. So you have that in your favor, which is risks, which gives you skewed rewards playing silver versus gold right now. You're seeing it with like the GSR going down. And after that, if we go down all the way to minus 1.5 real rates, I'm estimating if those parallel lines are respected, that silver should be around $44, $45 by the time we get there. So it's not 70. This is probably more realistic. The 70 target, remember, is based on a copy paste from a previous moves in the 1970s, but it's still giving me a target that's getting close to those all-time highs, and I know I have fuel to get there. If it melts up and goes parabolic and goes above 44, it's very possible, but I think that I'd really be curious to see how silver is that price when the real rates, if ever they go to minus 1.5 there, how this chart's going to look like. And the problem is I do so many charts that I'd actually need somebody to remind me to refresh charts because I've moved on, unfortunately, to another rabbit hole. But this one would definitely be cool to keep an eye on this one there.
So Patrick, I think this is a good spot to talk a little bit about the way that we're able to identify these melt up tops. Obviously, as a trader, identifying tops or near, let's say, 5% of a top would be super valuable to be able to know when to sell and to take our profits. So how do you go about trying to figure that out?
Well, this is part of it. So right now, if you're able to identify regions where silver previously topped, so not on the silver chart itself, but on like, let's say micro drivers like real rates for silver, then you could estimate that, okay, I think that silver is going to start topping when we get close to that bottom rail. But then after that, yes, you do look at the actual silver chart. You could look at the angle where it's at, how far it's extended, the angle of going up. But it's honestly grabbing at the top 5% for silver. You'd probably be super lucky to do that. Or like a genius, a mad scientist who has the precise formula to know exactly when it's going to top. Because the problem with those parabolic extensions, it's just so violent. Like one day you're 7%, the next day you're going up 14%. And then like, when is that train going to stop and topple over, right? Because if you stop 2-3 days early, you're going to miss out 20% of that ride, right? So it's super, super tough to get off on the exact top. But you have to go with previous like evidence, those distance from the moving average techniques there that I've shown there that could give you clues that, oh yeah, you're getting close to a top. Micro drivers topping out, commitment of traders giving you clues that it's fully extended and it's starting to wind down. Those are all elements there that you could add. And that's the best we could do, Tom, is give yourself probabilities that, okay, I'm reaching close to the top. But calling the top just for the bragging rights and getting off top 5%, that's going to be super, super, super hard to do.
Absolutely. So let's look at some more evidence here on our commitment of traders chart and explain to us why the commitment of traders, that data is so pertinent to what we're looking at.
An advantage of trading silver, gold, or commodities is this commitment of traders. It's like a hidden vault of data that's peripheral to the chart, and it helps you add evidence. But being like a newbie to the precious metal sector is like maybe now time's running by so fast. There are a couple of years. I didn't have preconceived notions of how I should read this. So I just looked at the chart. I tried to observe and see patterns and how it previously behaved. So on the silver chart, I see analogous move to like that 2010 explosion going higher to the top 2011. On the price action wise, it looks pretty much the same. Open interest, it looks pretty much the same. So we were doing kind of a lower highs tightening formation on the open interest and exploded higher. If it wouldn't be for the March Madness lows, the open interest wouldn't have dropped that much, and we would have had pretty much the same type of formation. And open interest right now is just starting to climb up. It's like fuel, right? When you want to see the open interest keep going up and up, that's more people jumping on board, driving the direction of the trend in progress. So that's right there. That's for me. Okay, it's good. I still have fuel. I'm not topping out. I'm not even close to my all-time highs in open interest. So for me, that's a safe spot. And the COT index, you guys looking at us on YouTube, the top rail of the COT index is when there's extremes. So this, I think, is for the commercials or large traders, but it doesn't really matter. It's if there's an extreme on the top, you're doing a bottom for silver, and that's a great opportunity to start thinking of adding. And important tops for silver were happen when the COT index went down all the way to zero. So in 2011, you saw when the COT index went down all the way to the bottom rail, we had an important top, and the COT index is pretty much behaving almost the same way. So we're doing lower highs. It's consolidating right now. It's digesting that pullback we had recently of the 27, 29, but there's still fuel. So add the fuel from the COT index going down. So until the COT index hits zero, I'm not super worried that there's an important top in. Until the real rates go down to minus 1.5, I'm not super worried that an important top is in. So that's really like, it's just added evidence. So I'm able to sleep well at night. If let's say the silver would be going up, Tom, and we'd be at the bottom rail already, I'd be, it's like greed, And then I'd be saying, okay, I'm going to stay in the bottom rail for a long time, and it's going to be different this time. But right now, you don't even have to worry about that because there's actually fuel to ride this. And the bottom section, non-reporting, small specs, well, everybody laughs at them. But when they get on board, so the green lines, the total positions, when they explode, it's the total longs. When they explode higher, they fuel the trend. I don't know if those are the Robinhood traders or the retail like us. And right now we're breaking out above an important trend line, just like in 2011, and there's fuel. So until we go test those previous highs on all those indicators for the community of traders, even if like silver looks super parabolic and it is correcting right now, and it'd be fun to correct a little bit more to let the moving average catch up, there's still fuel. So I always go back to this chart before I decide to sell my positions. I say, okay, Pat, it's a simple correction. It's not like a cyclical low that we're heading into. It's just part of the process. It's the wiggle out process there on the way up, guys.
Perfect. Let's move on to our silver's 1 hour log chart. I was asking you before the call if you could define contango for us, and you have a perfect illustration here of how to kind of visually see it. So walk us through what contango means, please.
Contango, it's another rabbit hole of the precious metals. So precious metals, you have a spot price. So that's the chart you have on top. It's just, I think, the price that you pay for silver to get it right now. But the contango or backwardation, or you could say premium or discount, is how much more you have to pay to hold that futures contract for future delivery. Since March Madness, usually the contango or the premium over spot was for the futures contract. And now I'm comparing to the next contract in front, not the current contract in front. It used to be very low, so not a lot of premium. It's like it doesn't cost you that much more over spot to get a futures contract. And after March Madness, it started exploding higher. So very sensitive to demand in the futures contract, and say, oh, a lot of demand, we can't handle it. I don't know what reason. And then you have to pay 20 cents, 30 cents. And if you look at the right axis, there's some peaks that you had to pay 70 cents over spot. So even in spots, it was $18. You had to pay $18.70 over spot to get a futures contract for physical delivery. So when you see those extensions, so let's say a lot of people want silver and the premium over spot super high, it's like a sentiment indicator. It's telling you, oh, a lot of people want it. So that means you're probably close to a top, right? Everybody wants it. So there's not enough new people that want it to driving the price up. So that could be an indication to sentiment extreme. But this one works very well for sentiment extreme on the downside. So nobody wants silver. So every time the contango, the premium over spot went below, I identified a line like at 19 cents over spot. It was like, oh, nobody wants silver. Silver's boring. That's when silver was cheap. That's when, okay, it's time to load up. We're at the bottom. Nobody wants it. And then we're able to ride explosions up. So I have I identified 3 domes on the 1 hour chart since March, the madness. 28% move, 16% move, 49% move every time we bottom and then exploded higher. And right now, even with the parabolic move we had, we've deflated recently with the price action stalling. We've deflated the contango, the premium over spot. So now we're I think at 27 cents. Maybe today it might have changed because of the price action. I don't know where we are exactly, but it's going down. So for me, the correction, we're closing into a bottom. I have 2 trend line. So the first pullback could stop at close to 26, 25 for silver. If that breaks down, maybe we're going to go down to 22. But from what I see now with the sentiment, strangely enough, resetting. So the premium over spot going down. This is not like sentiment, like how much people are bullish on Twitter. This is actual buyers and sellers of a futures contract, like real implications in the actual price market. It's low. So I see this evidence combined with the other evidence that we haven't redlined all the macro drivers for silver. We're kind of approaching a consolidation bottom here. So I don't know exactly where we are. We're going to have to wait to see if we bounce off that upper trend line or not. But we're on the good side of hitting a bottom more than the top. So that's how I use contango premium over spot to identify if people like silver or they've given up on silver.
So Patrick, one last thing before we leave this chart. Can you just define for us the premium versus spot? Is that the premium of the physical over the spot price that people are paying?
Yeah, it's for the futures contract. So futures contract, if any experts on the contracts there, I say any blasphemy, please be nice with me. But it's how much more money you pay for the futures contract.
Excellent. So it's not necessarily the physical price. It's the future price over the current.
Yeah, it's the paper market. So some purists, they could catch me on that. But futures contract, I think in theory or even in practice, right, they could essentially you're buying for future delivery of the metal. If the metal's there or not, that's another rabbit hole conspiracy you could go down into. But yeah, it's for physical delivery.
Perfect.
In the future.
Excellent. That's a good clarification. So we have our next chart here is really interesting, and something or at least I haven't talked about on the show before, is this sugar chart. And you have a very interesting overlay with gold. So tell us a little bit about why sugar tends to lag gold, and if you thought that silver was the way to play a commodities bull market, tell us why you think sugar could be even more explosive.
Sugar is like when I started like looking at precious metals, what drives them, inflation, and then you fall on the sugar is extremely sensitive to inflation, like cost of living type of inflation, right? Sugar is everywhere or whatever reason. And then when you do a PNF chart, again, I always go back to my PNF charts just to see price action movement and reduce like the noise of time. And then you see the gold chart and silver, sugar. When gold usually sniffs out the inflation or the like monetary imbalances that will create inflation ahead of time. But after that, sugar confirms, oh yeah, gold was right. I'm exploding higher. There is real inflation. There is real, whatever, like I'm going up, and it goes ballistic. I've noticed sugar goes as haywire as silver. So it's like, if silver is a poor man's gold, then sugar is a poor man's silver, right? It's going to break out after. And going to give you crazy return. And it actually confirms the whole loop that gold metal started the party, then the gold miners and silver miners. When we see sugar break out, and right now you could look at the stock setting up exactly like it did the previous 2 times that it exploded. The price action is repeating pretty much a nice coiling that it's done previously. If sugar confirms this and explodes, and I think if it explodes, it's going to explode violently. You know, you look at the up legs every time sugar exploded, small consolidation, exploded. This is like inflation on, or inflation expectation is going to be on. And that's just like going to reinforce silver. Gold's going to keep going up. We're going to be in that type of cycle, which reinforces what all those guys doing cycles, those that have been saying for a while that we're in a precious metals cycle for 16 years. It all reinforces that. It's like more weight of evidence just to add on top. And yeah, if you think you're late for the gold and silver party, well, just wait for sugar, man. Because I think sugar is going to be I'm very bullish silver. It's going to be a great play going forward there if it could break out.
Excellent. Let's move on to one of your favorites here, SilJ.
Yeah.
The expand and contract analysis. Tell us a little bit about what the overlays are here and why they're important.
Yeah, this chart, a lot of info. I try to make it as visually appealing as possible, but it's like a one-stop shop telling you how silver, like people, oh, my miners, they're not going up. Silver's going up. Silver miners suck and all that. But we don't have a lot of information for SilJ because it started recently. But just look at its last bull run it did in 2016. So the bottom part is silver. So I just have the silver futures as the bottom. And then I added the extra percentage move that SilJ done. It's always outperforming silver. So people saying silver outperforming, you're getting more move always with SilJ off those bottoms, and it fluctuates. So at the beginning, it's expanding away from silver, then contracting, then expanding away, contracting. And we've already done 2 of those phases. So the craziest time to get in, SilJ was actually, while off those March Madness lows, it was actually time to load up the truck on SilJ, not silver. SilJ, it was only 53% above silver futures performance-wise. And then it just expanded like crazy, 84% away, pull back to 84% away. And right now we're consolidating. We're pretty much, I think, close to the halfway mark. It could go a lot higher, but it was a halfway mark back in 2016. We're about 113% extra move for SilJ versus silver right now. And it's contracting. It's getting closer and closer. And it's just a question of time where it's going to really start expanding. When everybody gives up on SilJ, miners underperforming, it's the end of the bull market. Because you hear that often, like when the miners start underperforming the metals, it's the end of the bull market. They're the first ones to go down. But we're not in 2011, guys, or 2012. You've seen the weight of evidence, like the interest rates, the real rates going down, the COT index, all that evidence. You got to keep your eye on the ball. Don't get scared with doom and gloom. There's Gold Ventures, a guy I follow on the Twitter. He had a great post about emotional. He doesn't fall for those doom and gloom scenarios. They hinder him from making profits. If you're always worrying about the next crash, always worrying about something crazy that's going to happen, you're never going to get in. You're always going to wait, and you're going to get in when it's way too late. And that's probably when the crash will happen.
That's so a great point.
Yeah, it's like, I love that doom and gloom scenarios. They're great for table talk. They're great, but they're horrible for trading. Horrible. Just do like weight of evidence. Just look at the charts. And right now, there's a crazy move that's going to happen in SilJ. So all those guys, the Cœur de like CDE, HL, AG, First Majestic, all those guys, take a mags in there, like all those names that everybody's going to start knowing very soon because they're going to look at the composition of SilJ. All those guys, big moves ahead. And I can't even imagine for the smaller juniors there, they're going to get their turn going ballistic.
Perfect. So our last one, just to add to our more weight of evidence, is the Dow Jones versus silver. So with the 6-year moving average, again, it just gives us more evidence in this direction, right?
Exactly. So after all that, sometimes I still want to like take a bird's eye view. Okay, Pat, okay, you're drinking way too much opium. Let's calm yourself down. And actually, after I did this chart, I actually drank more opium because if we close, every time we've closed, silver has closed below its 6-year moving average versus the Dow. You've been in a severe outperformance of silver versus the Dow. It doesn't mean that silver is going to keep going up all the time. It's just that if the Dow goes down, you're going to go down less. And you're always, if the Dow goes up, you're going to be going up more. And for those guys on YouTube, again, it lasts about in 2071 to 79, 78, lasted 7 years. So that's a 7 years, sleep well at night, that your silver is going to outperform the Dow. 2011, 2001 or 2, all the way down to 2010, outperforming the Dow. Just 1 year that it went flat versus the Dow. The rest outperforming year after year. And right now, if we close the year, we have a severe red candle below that 6-year moving average, which is now declining. So we're just starting the bull market. Crazy enough to say, even with the silver at 26, we're just starting the bull market. And it fits with cycle analysis a little bit. We could be in 7 years, or if we add 9 years to this bull market, it's going to pretty much, even the 9-year one is going to bring us to 2029, 2030. And that's when silver, another region where silver is probably going to have topped. So when we're in that bottom quadrant, that's another place where you think, okay, silver might go parabolic, and it's run close to that. So yes, we're going to have a 20, 30% corrections or 50% retracement in those 2023 lows for the precious metals. But the big picture is a lot of profits. So imagine those miners, if you're able to hold on to that, you're going to get some Kirkland Lake gold going up. You're just at the beginning, right? So when the money can keep flowing in, because this is like Jordan said, that's money flowing out of U.S. equities into the silver market. So I had the gold chart, but if silver outperforming the Dow, you know that gold's going to be outperforming the Dow. It's money going in those. So guys, it's like sometimes I put like captions that are like, I think it's going to go to the moon. But like I said, there's no stopping this train. There's a lot of noise on smaller time frames. And this is a yearly candle. So there's a lot of noise, going to be pullbacks, and a lot of stuff going, news in there. But overall, the trend, the cycle, everything's on your side. If you're able to buy and hold and not be over leveraged and be able to live through those drawdowns, you should have some very good returns over the next decade.
Some sound advice there, Patrick. And ideally, I think that's what everybody would strive for, is to be able to make the right trade and still be able to sleep at night. Is there anything else you'd like to add before we wrap up here?
No, I'm just happy to be able to share the charts. And I keep listening to your channel there every time you have a new guest there, and I'm learning all the time. So I'm just happy everybody's out there is sharing, and seek comfort there that we're at the beginning of this. And when the evidence changes, then we can't stick to our guns. We have to accept that the bull market's over, and we'll be able to keep ourselves in check as a community.
Perfect. Just a reminder, Patrick is BadCharts1 on Twitter. He posts a lot of great charts and not just necessarily the stuff we went over today. If you have any questions or want to let us know what we got right or what we got wrong, please don't hesitate to reach out to Tom at palisaderadio.com or either of our Twitter pages. Thanks for your time today, Patrick. I really appreciate it.
Thank you, sir. Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?